An absolute bombshell report just out from the Fed shows our largest foreign creditor is actually a bunch of 100 to 1 levered hedge funds in the basis trade who have absorbed nearly half of all US debt issued in the last 3 years. The Fed just revealed a massive risk is lurking in the shadows of a small tax haven island nation. With SOFR spreads blowing out recently, this basis trade bomb could detonate again, sending shockwaves through markets. So an absolutely unbelievable report out from the Fed just in the past couple days that links in well with the repo market videos that we have been covering pretty exhaustively with SOFR spreads. It all links together. The basis trade, you've probably heard of it. I will try to explain everything in simple English. Here's some context. Gross debt stands at about 36 trillion. Of that, 9.1 trillion is held by foreign investors or institutions. Of course, foreign held debt is a share of total government debt. That peaked back in 2012, right before the Fed started QE3. The gold backing of our total debt, valued if you mark to market at 1.2 trillion, that backs about 3% of our total government debt. Remember, historical average is close to 30%, so gold has significant upside still in it to get back to that historical backing. And then market value of the gold relative to how much it backs the foreign held debt, about 13%. And of course, we always cover the tick data. This comes out from the Treasury Department and tells you who holds our debt. And as we can see, at least from the initial data, Japan holds about 1.1 trillion. UK, twin deficit nation, don't like to see them as a large creditor, but they are number 2 at about 900 billion. Then China is number 3 at 700 billion. And then the Cayman Islands there at about 400 billion. Well, the problem, as the Fed themselves reported this out, that they have been severely undercounting the Cayman Islands exposure to U.S. Treasuries by $1.4 trillion. So once you factor that in, Cayman Islands, a population of like 30,000 with an annual GDP of $7 billion, $8 billion. For context, annual GDP in America is $30 trillion. So this tiny island nation is by far our largest creditor. This has massive, massive implications. Just almost unbelievable report from the Fed. So here is why. They are engaged in the basis trade. All these hedge funds are highly levered in this so-called basis trade. And we'll go into that, but you can see here the size, the gross short position in futures, which is half of the basis trade, accounts for $1.2 trillion. And this is another massive implication. If you look at who has bought our debt going back to January of 2022, about 40% of it has been highly levered hedge funds in the basis trade. So the first thing to know about the basis trade is, of course, it is quite large. As we just saw, over $1.1 trillion in short positions on the futures contract. The other thing to know is it is massively, massively leveraged. So estimates range from 50 to 1 to as high as 100 to 1. Now, remember, this is seen as relatively risk-free. You are just collecting a very, very small spread, about 10 to 30 basis points, but you are levered up as high as 100 to 1. So to explain this in simple English, say I'm a hedge fund, I'm in the Cayman Islands. I want to engage in the basis trade where I short the futures contract for the bond and I buy the underlying bond and I collect the small little difference between the two. Okay. I go to my prime broker, who's a very, very large bank, and I say, look, I'll put up $1,000. I want you to give me $100,000 or 99 so I can buy $100,000 worth of treasury bonds. Well, immediately at the same time, now that I have $100,000 of bonds, I can go pledge those in the overnight repo markets and get cash for them. I'm still long the actual bond. I still have ownership of it, even though it's temporarily on loan. I'm still long that bond. And in exchange for providing those bonds as collateral, I get cash. Well, that covers, of course, the margin. And you just repeat this over and over and over again, where to a point where I could have $1 million of bond exposure and only have put up $10,000 of my own cash. So it is extremely highly leveraged. And this is what it looks like when it goes right. Now, remember, treasury bonds are risk-free collateral according to the financial system, and you are delta neutral. It doesn't matter if bonds go up or they go down, because if they go up, well, you're long the underlying bonds. And if they go down, well, you're short on the futures contract. So it doesn't really matter which direction bonds go. What matters is the difference between the futures price for the bond futures contract and the actual bond price itself. And remember, it's a very, very small spread And as expiration nears, you can see that the futures contract converges with the cash bond price, and you basically pocket that small difference. Here is what looks like when it goes wrong, and it has gone wrong many times over the past 10 years or so. And we'll take a look at one example. Here is what happens when it goes wrong. So remember, I am long the bonds, say $10 million of treasury bonds. I only put up $10,000 of my own money. I'm long $1 million of bonds, and I'm short the futures contract. Well, what happens if futures start to widen? What happens if instead of converging like it normally does, what happens if it starts to go the opposite direction? Maybe someone else is getting margin called. They have to get out of their basis trade. This is a very, very popular trade on Wall Street. So they're forced sellers of the bond, pushing downward pressure on the bond, and they're forced buyers of the futures contract. Because remember, to close out a short, the way you close a short out is by buying it back. So they are putting upward pressure on the futures and downward pressure on the bond. Well, that's squeezing me because I'm in that exact trade, and both directions are going the opposite direction. So now I might get margin called. I have to sell my bonds and buy my futures contract back to close the trade out. Puts even more pressure spreading the basis out instead of going the direction that it should. So here's kind of that gap, or one way to think about it. This is adjusted for contract changes. The front month futures contract for the 2-year Treasury future relative to the performance of the 2-year Treasury ETF, the underlying bond that I am long. You can see there's a very, very small gap there. And when you lever that up, it might only be 10, 20, 30 basis points, but you lever it up 100 to 1 and you can make serious money. So here's from another Fed report, which I will also link in the description, that shows the basis. And they use option adjusted futures basis, and they factor in the carry cost as well. And you can see various periods of time where the basis trade was quite lucrative. Again, this is a very, very common trade amongst Wall Street. So here we're looking at 2023, about $500 billion of net cumulative treasury purchases by hedge funds was specifically for the basis trade. So this has been popular, again, for a long time because it's seen as a relatively risk-free way to make, 10, 20 basis points, but you lever it up 100 to 1 and you can make decent money. And again, it doesn't matter which direction bonds go. If they go up, well, you're long the actual bond, so you're fine. If bonds go down, well, you're fine because you're short the futures contract. So here we can see that the short position in Treasury futures, this was a dated report back from 2023, it was already over $1 trillion when you include the 10, 2, and 5-year treasuries, and then the long treasury bond exposure on top of that was quite minimal, and I will link that report as well. So here we're looking at Bitcoin, where it's a little bit more pronounced. For the year 2024, we're looking at the front month CME contract for Bitcoin, not the perpetuals, the front month CME contract. And generally, futures are in contango, where you have to pay more to when the future expires every month. You have to pay a little bit more to roll into your new long position on the new monthly contract. And of course, generally over time, that future kind of decays back to spot, which is the basis trade, and you collect the spread if you're in the basis trade. Well, we can see for Bitcoin, for example, this roll decay was quite significant. It is not nearly the significant in the treasury market, but just to illustrate the point, that contango, having to pay the excess basis every month when you roll your contract, can add up to quite significant decay in your returns. We can see spot Bitcoin was up 145% for the year 2024, whereas if you were just rolling futures contracts, it was only up 96%. So the basis trade was also going on in Bitcoin, by the way, where the basis was much higher than 10 or 20 basis points. So here we're looking at an unwind of the basis trade. This is the risk, and it ties in again to the SOFR market and the repo stress that we have been covering exhaustively. So back in 2020, again, generally you expect spot to be a little bit above the futures. And sure enough, it was going into 2020, say February, into March. You can see TLT, which is the long bond ETF, was above the bond futures contract. But then the basis trade started to unwind. Well, one of the reasons it started to unwind was bond market volatility started to skyrocket. So going back to this example here, that eats into the haircut to some degree. That eats into the haircut and causes a margin call in effect to some degree. But we also see the basis started going in the wrong direction. So TLT started to trade below the futures contract quite sharply. So here at the peak, when I marked with the pink line, that was about 400 basis points of the basis in the wrong direction, right? You are trying to collect the difference between the futures contract that you are short and the bond position that you are long underneath. While I marked in pink, sure enough, we can see it was when SOFR started to blow out. Bond market volatility had started to blow out before, probably again affecting the haircut in the various levered basis trades and having a bit of a ripple effect. But we also saw funding stress via the repo markets. We can see that because SOFR, which reflects actual supply and demand for dollars in the repo market, the actual cost of capital rose far, far, far above what the Fed was trying to set in terms of the floor in the price of a overnight dollar loan. We can see at the peak, it was about 54 basis points SOFR to reverse repo. Well, of course, recently, we have seen a widening of SOFR. We have seen elevated liquidity strains, now even above the discount window, which, just as we were talking about the reverse repo award rate, that is the Fed trying to set a floor in the price of an overnight dollar loan. Well, they try to set a ceiling. They say no matter how scarce dollars get, we will always sell them to you at 4.25. Well, SOFR is now above the discount window rate for 2 days in a row. And again, it's normal to see some funding stress, some liquidity strain at month end or quarter end. SOFR will blow out sometimes above the Fed funds, above IORB, certainly above the reverse repo during end of quarter, end of month. But again, we are in neither of those. Of course, we saw a tax deadline, which is another significant strain on liquidity. So what happens here is that, remember, I'm long $10 million. I'm highly levered, 100 to 1 in my basis trade, and I'm constantly, every day, rolling my position in the repo market. And that might make sense if SOFR, the cost of doing that, rolling that 100 to 1 levered position, if the cost of that is relatively contained, if SOFR is relatively contained, and I can rely on it being, nearby to Fed funds, say, then that might make financial sense. But if SOFR starts to rip higher, remember, I'm levered 100 to 1. So every basis point that I have to pay adds up. And so as SOFR and the funding cost starts to get elevated, that can cause a margin call on my highly levered 100 to 1 levered position. So I have to, again, sell the bond, which puts downward pressure on the bond, just like we saw here. TLT, the actual bonds, were trading far below what the bond futures were, because again, to close the basis trade, you buy the futures contract. So that puts upward pressure. And again, that pushes the basis going in the wrong direction. So when it works correctly, again, you can make, decent amounts of money, relatively delta neutral, relatively risk-free. This is what it looks like again when it goes right. The futures generally decays to the spot price, and you collect that difference. This is what happened in 2020. It went all wrong. And in addition to this kind of basis trade and the potential shock that this can cause, just the fact that without adjustment, this is what our foreign holding of U.S. government debt looks like, and this is what it actually is. And the largest holder of U.S. government debt is 100 to 1 levered hedge funds engaged in this basis trade in some tax haven with a GDP of like $7 billion per year, a population of like 30,000 people. This is the largest holder of our government debt. This has massive implications. Then, of course, you look at the second largest, or the third largest after accounting for the discrepancy here, and it's a twin deficit nation that's arguably in a debt crisis, in the early stages of a debt crisis. So this is not good for the bond market, for the treasury market, for bond yields. This is not good, because if the basis trade starts to unwind, again, we established that when the basis trade unwinds, you are selling the bond. Remember, that means that the yield, which is inverse to the value of, say, TLT, is going straight up. And of course, this, with highly levered economy, 125% debt to GDP, 7% pro-cyclical annual deficit, 23% of our tax receipts are going to interest rate. We are highly levered. We cannot afford to have a dislocation where interest rates are shooting higher because bonds are getting sold due to basis trade unwind. Because again, to unwind the basis trade, you sell the bonds that you are long and you buy back your short futures contract, putting upward pressure on the futures contract, downward pressure on the bond, which of course pushes the yield, which is inverse, up. So anyways, certainly a lot of risks to keep an eye on. I will link to all these reports in the description. I would highly recommend reading them. And anyways, hopefully that made sense and hopefully that was helpful, and I'll catch you in the next one.